Thank you for joining us. This is Business Morning on Channels Television, and we're glad to have you. I'm Bisi Adebayo. We'll begin today's show with the World Bank's latest economic outlook on Nigeria's economy, which is expected to contract by 3.2% this year and 1.7% in 2021. And that's due to the collapse in the oil prices and the impact of COVID-19 in the country. The new forecast by the World Bank comes just barely a month after the federal government said it expects the country's economy to shrink between -4.4% and -8.9%, while the International Monetary Fund in April projected a 3.4% contraction this year. And the World Bank also expects the global economy to shrink by 5.2% this year due to the massive shock from the coronavirus pandemic and the lockdown measures to contain it. Meanwhile, the Central Bank of Nigeria has waived the requirements for the provision of guarantors by households and SMEs for the 50 billion naira COVID-19 targeted credit facility. According to the bank's Director of Corporate Communications, Isaac Okoroafo, the move is to reduce the concerns of those who had fulfilled all requirements for the loan but are yet to have their accounts credited. Mr. Okoroafo adds that all successful applicants who have submitted their account details for the facility should expect to be credited within 48 hours after approval, while other successful applicants yet to be credited should visit the website of Nersol Microfinance Bank and input their account details. He also notes that the palliative being disbursed the loans that should not be taken as grants. Let's talk about oil prices now. They've actually turned lower today, and that's after the easing of coronavirus lockdown measures across the globe earlier lifted trader hopes for a swift recovery in demand. Brent crude futures were down 0.64% earlier at $40.54 a barrel, and US WTI futures were also down 0.58% at $37.97 a barrel after dropping $1.36 on Monday. Meanwhile, Libya's National Oil Corporation on Monday announced it has restarted production at the Al Fil oil field with an initial output of 12,000 barrels per day and will return to full capacity of 70,000 barrels per day within 14 days. And that's just as it lifted the force majeure over crude exports from Al Sharara and Al Fil oil fields. The NOC statement was released after OPEC Plus announced output cut decisions last Saturday. Saudi Arabia's latest comments and Libya's production prospects are the two key issues on the front burner at the global oil market today. And we'll begin our conversations from there right away with the chief executive of the Jeconic Hydrocarbon Asset Management Consultants, Mr. Abiodun Adesonya, who joins us now to x-ray these developments. Good morning, Mr. Adesonya. Thanks for joining us on the program. So we're seeing that oil prices have been unable to sustain the tempo after the OPEC Plus agreement on further output cuts till the end of July. But does that prove the fact that the output cut agreement is just not enough to give the market the boost it requires?
I think the challenge goes a little bit more than that. The issue is, again, everything is driven by supply and demand system. So these cuts that are coming in now, which are kind of not being able to sustain the oil price that we're looking for, remains a challenge. Don't forget that the issue of production the issue of demand, has been a major problem. As of the moment, we see cargoes that are offshore looking for where to discharge and all of that. So I don't think we're there quite yet.
Now, Saudi Arabia on Monday also indicated that the kingdom and Gulf allies, Kuwait and the UAE, would not cut production voluntarily by an extra 1.18 million barrels per day in July as they are doing this month. And what implication will this have on the OPEC Plus meeting agreement?
It's going to be significant. Don't forget that the volume we're looking at Saudi Arabia and the allied Gulf countries cutting is quite significant volumes, and will have a very significant ramification in the supply system globally. Saudi Arabia is probably taking that position because they've seen other companies not strictly following the agreement that has been reached in the April meeting. And therefore, they are basically saying, well, if you guys can't hold on to what has been agreed, then we are going to follow the same. So it's going to have significant implications in the supply system, and that's something that should be of a concern to all OPEC and the OPEC Plus members countries.
Would there be any particular reason why Saudi Arabia is pushing this agenda?
I guess it's to whip everybody back to line. Don't forget that it could also be counterproductive. Saudi Arabia just had an IPO out, and they are looking at being able to fully satisfy the shareholders they are hoping to capture in that IPO. And that satisfaction can only come from a reasonable and decent oil price. So to that extent, if they do a tit-for-tat approach, if they adopt that sort of approach, it's clear that it could backfire to some extent. Russia is a major producer, and they are probably one of the countries that also didn't quite follow the agreements reached. Therefore, we're going to just see a war, a supply war, so to speak. And that's not good for the oil price at all.
Well, coming off a ceasefire in Tripoli, Libya has just also announced a resumption in production with expectations to return to full capacity of 70,000 barrels per day within 14 days. Should this actually be a source of concern, considering the objectives of OPEC, which aims to prop up prices?
70,000 barrels per day is not an awful lot of oil. I do not expect that to have significant impact on global oil prices. It can send a message, and I don't know if 70,000 is the cap they have, or perhaps it's just the starting point, and they are looking at ramping up. By the time they begin to ramp up that production from 70,000, then I think it will begin to call for some attention, yes.
Now, let's look at shale oil in the U.S., which saw a total of 1.15 million barrels per day shut down in April and May. But output is expected to return swiftly over July and August. What sort of impact will that have on oil price currently, which is hovering around $40 per barrel?
Okay, definitely that's going to create additional stress on the supply system. We're going to begin to move towards a glutting scenario of the supply, and where we have gluts, then the oil price will come down. So pure and simple, the more oil in the system, the lower the oil price. I think that's just basically the effect of what that's going to cause.
And talking about the price of oil now, Morgan Stanley yesterday commented that the current oil price rally won't last because the rally is mostly supply-driven as opposed to demand-driven. What are your own projections?
Basically, that is a very correct, a very valid statement. Again, this is supply-driven because the needs are reduced, especially during this pandemic. And as long as the pandemic remains there, we're going to have this problem. Of course, there's a gradual reopening of activities, economic and commercial activities across the globe, but it's gradual. And even at the peak of it, when we are fully opened, we're still going to have that supply system still, but that's when I hope that the oil price will begin to take its appropriate position. And that's why we've always assumed that this recovery will be very gradual.
Well, bringing things closer to us now here in Nigeria, and as part of the fallout of the OPEC Plus meeting, Nigeria and Iraq have agreed to make additional cuts. That's to compensate for the breach in May, June, between July and September. How would you expect the regulators to manage that commitment?
It's going to be, I've read that news as well, that we're going to compensate for the overproduction. But if you put that against your earlier question that Saudi Arabia had already indicated that we're not going to comply, even if you do that, that's the implication, even if you do that, then I think there's still a problem. which I believe OPEC members still have to try and have a convergence on as time goes on. The biggest challenge is the regulators over here will simply have to get all the operating and producing companies to have cuts, which they've already done. So it's not so much of the companies that are operating in Nigeria not following the rules. It's about what we are pumping out. So if we're talking about regulating that, I think from the government side, they can easily handle that. That's the Crude Oil Marketing Division of NNPC, who normally schedules the lifting for these productions.
Now, some explorationists believe that Nigeria is more of a gas nation than oil. And looking at the Ajaokuta Kaduna Kano project, for instance, now, how much of an economic benefit will the reality of that project bring for Nigeria?
It's going to be significant. It's going to be a major game changer, especially in the economic development and expansion in the northern part of the country. Kano, for example, as you know, is the commercial hub of the northern Nigeria, and being able to get gas there will obviously energize the factories, the industries, and overall boost the commercial activities from there. And I'm pretty sure that there will be other derivatives of that, expansion of that or fallout of that into the other parts of that region. The gas is going to come from Ajaokuta, which means that the Oben-Ajaokuta gas pipeline needs to be expanded, and then more gas needs to be pushed up into that line so that they can cater for what is being needed at the moment and what is going to be needed in future. But also, we shouldn't lose sight of the fact that oil and gas exploration activity is going on in the northern part of the country. And that could provide, is still in its very early stages of exploration right now. And that would definitely provide additional support if and when that gas becomes fully developed, when the resources there becomes fully developed and being produced. But definitely this will be a very positive, will have very positive impact on the economy, especially of the northern Nigeria and Nigeria in the whole.
Just before I let you go, Mr. Adesoya, I remember from our last conversation that, of course, players were battling with the issue of moratorium on their debt obligations. Has anything changed in this regard?
I'm not aware anything has changed, but let me clarify a little bit what I discussed at that interview then. The industry, is very familiar with and very used to oil price, fluctuating up and down. And we generally have contingent plans to take care of that scenario of lower oil price should it come. So it's nothing new to us. And when I say contingency plan, that includes meeting obligations as much as possible and all of that. So I can tell you for sure that there are some companies that are operating and still, despite the challenges we have, making significant effort to fulfill their obligations to the lenders that gave them facilities at the beginning. Some companies have been able to manage, when you have a surplus, you're able to save, and when you have little, you're able to deploy. So they've adopted that approach, and that seems to be working even through this period that we're talking about right now. So, but overall, I know that CBN hasn't moved, and I know that I'm not aware of any discussions that has taken place with the lenders, between the lenders and the borrowers, in terms of being able to arrive at some sort of moratorium or something that will cushion the effect of the current challenges they're having with loan repayment.
Chief Executive Officer of the Jaconic Hydrocarbon Asset Management Consultants, Mr. Abiodun Adesoya, thanks for speaking with us on Business Morning.
Thanks for having me.
Now, let's continue the conversation now at the domestic commodities market, and a research analyst at the financial derivatives company, Temitope Olubile, is here with us. Good morning, Temitope. Thanks for coming on the program.
Good morning, BC.
Well, let's take it up from where Mr. Adesoya left off. Now, I'm going to ask you, what's your view at the FDC about the whole OPEC Plus agreement and the output cuts?
Okay, so, the OPEC met 2 months after their meeting in April, and we saw that they extended the initial price cuts instead of, because at their meeting in April they had already they had factored in that, okay, fine, from April to June we'll have 9.7 million barrels cut, and then we'll now reduce it to 7.7 million barrels per day. And so them maintaining the 9.7 as opposed to kickstarting the 7.7, it shows that maybe there are still some concerns about demand. On the demand side, as we see more economies opening up, there's that increased demand for oil, but there's still concerns, especially when you look to the health aspect of it, or as health officials warn about a second wave, so they are still being skeptical about the demand side of things.
Now, is Nigeria really ready to compensate for the past?
I mean, yes, it's a question of if we're ready, but it's also a question of what happens if we don't, right? So you see that Saudi Arabia is, after their price war with Russia, they're not one to be played with, right? And as we saw in this meeting, the highlights of this meeting were countries that were non-compliant, right? And Nigeria was mentioned consistently among 3 other countries. So we can't afford the reputational damage, the revenue damage of, a sanction if worse comes to worse, from OPEC. So we need to comply. We need to, yes, there's the aspect of our oil revenue, the shocks to our oil revenue, but we've already had, we've had the shock from the price crash and everything. So we just have to comply if we don't want the damage that will come from a non-compliance.
One of the burning economic issues, as we can see there, is talking about external reserves in a zigzag mode now that we've seen, of course, shaping up to $36.55 billion, and then it slips again. So
yes.
Tell us what's fueling all of that.
I mean, just at the point where we were thinking that, okay, the decline in external reserves is gone, and now we are at the peak, especially as the IMF loan drawdown. But now we saw that we seem to have reached the peak of that, and we're back in the declining phase. And now, more so now, as we have the forex demand pressures, we're really hoping that external reserves will serve as as CBN pumps money into the forex market, the naira pressure would ease, right? So we see that now there's more pressure on the naira as a result of the shortage of our forex supply, and as more there's more demand, as airports we're hoping that it will be reopened by June 21. There's a pickup in forex demand, right? And with the shortage of the supply, we see that there's that pressure on the naira now, and especially now that the external reserves is on a decline. So we just really hope that the naira will stabilize, and we'll get more forex supply as the demand increases.
So what's the latest with the agricultural and domestic commodities?
Okay, so when we first of all started this whole pandemic, the lockdown restrictions, we saw that there was panic buying by consumers. There was even palliative buying by corporates, right? As part of like a corporate social responsibility. So we saw that demand. But now what we are seeing is that across the markets, there's this price discrimination that is happening. You see that the farther away markets are from the production point, the more expensive these commodities are. But this has been before even COVID-19, but now it's more manifest for all to see. So you see that there are lower prices in the Oyingbo Agege side, which is close to mile 12, which is where many of these commodities come from. But as you go further away from mile 12 and those markets, you see that as you come to the Sura side, Lagos, you see there is that increased price. There's an increase in price of commodities. So that's what we're seeing in the domestic market for now. And we also have the planting season has commenced for some of these commodities like tomatoes and pepper. So that's what's feeding into that. So you have logistics as a major problem right now for these markets, women, and that is really playing into prices, and we don't really need that. Our consumers do not need that because there's already the dwindling income. You see from the last MBS report, right, that over 40% of Nigerians have reported a job loss since COVID-19. More than 70% have reported dwindling disposable income. So the last thing consumers need, boring a hole in their pockets, is increased price of commodities.
Absolutely, Temitope. That will be a good point to leave this conversation. Research analyst at the financial derivatives company, Temitope Oluwole. Thanks for coming on the program.
Thank you for having me.
A government's capacity to invest in its people and sustainable development is dependent on the nation's ability to facilitate fiscal consolidation Now, according to the NESG Fiscal Policy Roundtable, taxation plays a critical role in this regard, and this brings to bear the need to find a long-lasting, sustainable solution to the funding gaps of the federal government, especially post-COVID-19. Now, the group explains in a recent report that tax is the cornerstone of an effective nation, an initiative that activates productivity and economic growth. Well, joining us now to examine some of the barriers to tax compliance and to proffer possible solutions is the co-chairman of the NESG Fiscal Policy Roundtable, Dr. Suleiman Ndanusa. Good morning, and thank you for joining us on the program.
Good morning.
So the NESG Fiscal Policy Roundtable has recommended taxation as a key fiscal action that governments must embrace, especially post-COVID-19. Can you tell us more about this?
Yeah, indeed, taxation is the cornerstone of any development. Without taxation, then there won't be any social contract, because what guarantees social contract between people and the government is taxation, so that people will pay tax and expect to be given all the facilities, the protection that they need. The roundtable, the NESG roundtable, has been working very hard. One of the things they did was to conduct a survey of the morale to pay tax in Nigeria, and the results were not very good, because there is so much low morale in paying tax in Nigeria, and the reasons are: one, the issue of trust, transparency, and the complexity of the tax system itself, both in law, administration, and of course the policies. And so many other things were found to lower the morale to pay tax. And therefore, citizens are seeking for social contract. There has to be fiscal exchange. They want to see things that their monies, if they pay tax, what are they going to get from government? Are there good infrastructure? Are there roads, electricity, etc.? If there are none, then obviously it shakens the social contract. So a lot of this morale, until government does something about improving the morale to pay tax and making sure that there is accountability, making sure that it's easy to pay tax in Nigeria, it will be very difficult. And that's exactly what the NESG roundtable and, of course, the government itself is doing, of improving ease of paying tax in Nigeria, because Nigeria is one of the countries around the world that is so difficult to pay tax, even if you are willing.
Having said that, Dr. Ndanusa, let me ask you, what's your assessment of how the pandemic has impacted the new VAT policy in Nigeria?
Well, the pandemic has affected business generally, productivity, economy. It has affected the productivity of our economy. And the VAT, you pay VAT, you pay tax because you are active in the economy, buying. Consumers are buying, consumers are spending, and therefore companies are producing and people are buying. And because of the pandemic, what it has caused globally at the supply chain and what it has caused also domestically, it has affected business. And for that reason, even though the rate has been increased from 5% to 7.5%, is going to affect the revenue we get from VAT, is going to be affected in terms of volume, because the supply-demand dynamics are going to be affected. In fact, they have been affected.
With all of this now, what are the main issues that need to be fixed for Nigeria to generate enough revenue to develop the country?
Well, one very important one is we have to diversify the sources of our revenue. It's very, very important that we diversify sources of our revenue. We have to develop data. We need data about taxpayers we don't have. We have to organize the informal sector. We have to create clusters of businesses, etc., so that they can become a taxable group. And then, of course, we have to also tackle the challenges of paying tax, like I said. I think the 2019 Finance Act has done quite a bit, creating the need for TIN, that is TIN, and so many others. So basically, therefore, we also have to block the leakages. It is very important that those factors that cause low morale to pay taxes will have to be fixed. And then we have to make our economy more productive, because we are so diversified. We have about 46 sectors in our GDP, if you look at the table. But the point is, most of those sectors are not productive, including agric. The value chain has to be made very productive so that we can flog the revenue out of those sectors. And until we do that, it will be very difficult because the GDP, the productivity of the economy determines how much tax you attract. Of course, by making tax easy to pay, the administration, the policies will all have to be brought together to enhance and to encourage people to pay their taxes.
If you were to recommend 3 fiscal priorities for the government, what will they be?
One is, like I said earlier on, government must diversify sources of revenue, and then government must look at how they spend the expenditure pattern that we have. It's not just collecting the taxes, it's not all just collecting the revenue, but how we spend it. For example, I would say government should there should be spending cuts. There are a lot of, we should downsize the MDAs, we should reduce cost of governance, the NAS, the National Assembly, etc. The Orosoya report is a point in this. We have to look at how we downsize the cost of governance and the MDAs. The second one I would say we must do quickly is we must prioritize spending. Where we put our money is very important. We put our money in infrastructure that will have multiplier effect on the economy. And I would suggest that we put our money in health, which is so obvious because of the pandemics. We have been so exposed. Agric education and, of course, infrastructure, they are very, very important. So one, diversifying the sources of revenue, then the expenditure pattern, spending cuts, and obviously prioritizing what we put our money on.
Now, let's look at the average Nigerian now. How do we increase domestic revenues via tax in such a way that it doesn't actually overburden them across the informal and the formal sectors?
Well, the average Nigerian has to earn revenue before he is taxed. So government must create an enabling environment so that the average Nigerian will have something to do and will become productive. One, those who are employable should be employed, and those who can be self-employed should be supported so that they can become more productive. But because without being productive, without doing something to earn revenue, it will be a burden to expect someone to pay tax for nothing. So it is important that the enabling environment will be created, and then people should be put to work either on their own or privately, entrepreneurship, and they should be supported. There has to be credit so that they can produce. We also have to encourage people to be more enterprising. And once we do that, obviously it's from what you earn that you pay government. So the burden can only be reduced when people have a source to pay to pay tax. Without a source, just like most people, the rate of unemployment is so much in Nigeria. And then, of course, even the informal sector is so disorganized that multiple taxation, etc., that have been the bane of taxation in most of the states in Nigeria is really a burden to a lot of the businesses, especially the small businesses. So there has to be a cocktail of policies, administrations, and even laws that will ensure that we create that environment that makes payment of tax easy and with very little burden.
Now, there are no doubts that the COVID-19 pandemic has had its negative impact on the economy. But if we see a decline in tax compliance post-COVID-19, what would be your advice for government to tackle this?
Like I said, one of the advice is to enhance the morale for people to want to willingly pay. People actually a lot of Nigerians are interested in paying tax. From the survey conducted by NESD Roundtable, the fiscal roundtable, we discovered that so many Nigerians are actually interested, even at the local level. But the point is, one, the tax system is so complex. The tax administration is so complex. Number two, they want to see value for money. If I pay tax, I want to see that by next year, I have a clinic to go to. By next year, I have a road that is passable. By next year, I want to be secured. I want to feel government. I want to feel that the social contract between me and government is working. So I think what government should do going forward, and I'm happy that this triple crisis that Nigeria has had, because as far as I'm concerned, we have more than 2 crises. It's not just Corona, COVID-19, or the crash of oil. We have been having pre-existing crises of development. And that is why people are not willing to pay. If you look at what has happened to Lagos State, when Lagos State started giving dividend for democracy, dividend to taxpayers, people became more willing to pay taxes because they could see better roads to pass, they could see more secured environment, cleaner environment, etc. And it's developing, and that is why the tax revenue in Lagos has skyrocketed. So that is exactly what we want nationwide. At the state level, even at the federal level, people want an enhanced social contract that is accountable, transparent, and fair. Until government does that, and I'm sure government wants to do that. That is why even the ease of doing business generally, you can see that in the area of taxation, we are doing very bad. In fact, we did worse in 2019 than we were doing before in terms of our position. So we must improve on ease of paying tax so that people will find it easy to pay and also will be willing to pay without being forced to pay.
But when you look at it now, Nigeria has huge budget deficits, which have only been made worse by the impacts of the pandemic and the currency pressures. Now, what advice would you have for government to ensure that Nigeria is better prepared for such occurrences?
Good question. Like I said, I think we are paying for our sins of development. If we had been doing the right thing all these years, we obviously would not be needing so much money to do things that we should have done 30 years ago in terms of infrastructure. We should have had good roads, the railways would have been there, power would have been there. So if you compare it with countries that are having similar problems of pandemic, the corona pandemic and also the oil crisis, you find that because they already have an existing improvement in infrastructure, etc., they are not desperate. But you can see that because we have a pre-existing development crisis, it's the burden of raising money to do so many things at the same time, things that we should have done. Hospitals, health clinics, etc., we do not have. Everything is being done now, and that is why there is a burden. And that is what is causing this, what you just asked. That means we have deficit financing. Now, unfortunately for us, we are not the only people, globally there's this problem. America is having this problem, GDP growth minus 5. You have globally that's going to be about negative 3% growth in GDP. Most of our partners, except China, even though they are not going to be having negative distance, is just merely 1.something%. So basically, we have a deficit and financing it is becoming very difficult. Our rating, credit rating is even low, almost a junk status. And therefore, even if we're going to raise money, we have to be prepared to raise it at a higher cost. We are lucky that the pandemic has made people to sympathize globally. The multilaterals are giving some of these funds that are cheap and probably long, but definitely we are not in a good position to bargain. We are very weak, operating from a very weak position because we are desperate, which is self-inflicted because we didn't do what we are supposed to have done 30, 20 years ago, and we are having now to battle with both infrastructure, battle with pandemic, and then we have revenue crisis. So the demand supply dynamics that we are having, it's also going to affect us. So basically, the business is down. We don't have money. We are having deficit. Deficit in our body is growing, and then even to raise money to do it is becoming more and more difficult because the demand for debt financing is growing across the world. So we are competing with other nations to raise it. Other nations that have better credit rating for them to be able to attract some of these loans. So definitely it's a problem. unless we seize this opportunity. It's a baptism of fire. We have to seize this opportunity to make some radical changes in the way we've been doing our things. We have to be more transparent, more accountable.
We would like to thank you, Co-Chairman of NESG Fiscal Policy Roundtable, Dr. Suleiman Ndanusa, for speaking with us on Business Morning. Time now to check the numbers from the markets, and Temple Ashaju is ready to do justice to that. Good morning, Temple. So we saw a bright start to the week at the equities market yesterday.
Yes, we did. And I mean, that's something that's brought back some kind of hope to a lot of the retail investors that have seriously been participating in the markets lately. We were up yesterday again, some 93 basis points, and brought back the equity capitalization to 13.17 trillion naira. If you look at the activity level, it was a little bit of a slow start in this angle at this end of the markets, because again, for the last 2-3 sessions of the last trading week, we had seen more of profit taking, a lot of the profit taking then brought back the prices to lower levels. So on that note, we saw value declining by some 16%, in spite of the fact that we got some gains around FBN Holdings, and of course FBN Holdings was the largest contributor to the volume of transaction yesterday. Deals we settled at 4,621. Now, if you look at the sectoral performance, the banking stocks made a comeback. They were green yesterday. FBN Holdings contributed to that. Axis Bank, quite a number of the banks that you have in this space continue to move on up yesterday. Consumer goods side of the market, thanks to Dangote Sugar, that is paying out 1 naira 10 kobo to investors. Investors have been betting on this particular company. And of course, industrial good end of things, incidentally, Bua Cement, which is one of the major companies that you have listed on the stock exchange there, a major large size stock, was also out with its Q1 2020 performance. The numbers drove the performance again yesterday, in spite of the fact that they are also declaring some dividends to investors towards a later part of the year, and investors have now been betting on this particular stock. It's crossed 40 naira in share price. Now, insurance segment of the market, WAPIC, which was the top gainer in the market yesterday, was up by 10%. That also helped contributed more to the insurance space, in spite of the losses that we saw on Cornerstone Insurance. Oil and gas was mixed. It actually settled positively eventually. FBN Holdings, we talked about earlier, where the Guaranty Trust Bank as well as Japol PLC were the key performers yesterday in terms of top trades. Look at the oil and gas segment. O&O contributed some 2.27%. Eventually, after the investors took bets on this particular counter with some 2.213 million units of shares eventually. Etana PLC, profits taking. This is a company at around 2 naira 80 kobo about this time last year. If you're one of those that hadn't been able to take profit, it actually settled around 2 naira 60 something kobo. That was an opportunity for one to actually take some profit. If you're one of that category of those that bought at a higher rates before and hadn't been able to touch back at that rate. Well, we have Mr. Fakroga Charles, Chief Dealer with City Coded Trust and Investment Company, joining us on phone. Mr. Fakroga, thank you for joining us on the program. Talk us through the performance of Bua Cement in terms of its Q1 numbers and how it's been revving up lately with the interest of a lot of the investors in the market.
Hello.
Yeah, talk to us about the performance of Bua Cement in terms of its Q1 numbers that were released yesterday.
Yes, thank you very much. We, as operators, we are not surprised about the performance of what the company came in to the market, and it has shown that it's a market leader in its own sector. And despite the pandemic, we've seen that these numbers are very encouraging to investors. It goes to show that the management of Bua Cement has really done a lot of strategic thinking in terms of their production capacity. They increase it, and we are seeing that reflected in their Q1 results. So this only goes to show that the management of what has really done a lot in terms of operating their company for the benefit of shareholders and for the economy, despite the pandemic.
Okay, Mr. Charles Fakroga, Chief Dealer with City Codes Trust and Investment Company. Thank you for sharing your thoughts there. Of course, we know that Bua Cement has also been contributing to the fight against COVID-19, helping the economy, helping the government to also cushion the effects of COVID-19 on the markets across board as well. Thank you so much for sharing your thoughts with us, BC. So over to you now.
We move over now to London, where Juliana Olayinka is standing by to bring us this morning's updates. Good morning, Juliana. So we saw a big announcement from BP with plans to cut 10,000 jobs following a global slump in demand for oil because of the coronavirus crisis. How is the market reacting to this the morning after the announcement?
Good morning, Bissy. Well, the FTSE opened lower this morning, but didn't really have much to do with BP. BP shares are lower, but there was, I would say, some surprise yesterday when the oil giant announced these job cuts of about 10,000 people, which is 15% of their workforce. And as you said, you know, oil has been dealt a really crippling blow since the pandemic has taken over. Demand has completely slumped, and with that, there's been a rapid decrease in the amount of earnings that BP has been reporting. So yesterday, their new chief exec, Bernard Looney, wrote an email to their 135,000 staff, basically telling them that they're bleeding through cash, that they're spending a lot more cash than what they are earning, and they need to make these reductions pretty swiftly as well. These job cuts will take place before the end of the year. There's about 5,000 BP retail staff here in the UK. At the moment, we're hearing that it won't affect them, but it's still pretty worrying. What BP is saying is that this is exactly the way they were planning to go anyway. They had already promised the British government that they would be a net zero emissions company by 2035, meaning that they would definitely have to be a much leaner, slimmer company with a slimmer workforce. So it is to be expected. Also as well, their US rival Chevron, they've also announced that they will be having similar cuts to their workforce of about 10,000 people. Now, there will, of course, be scrutiny because we know that oil is a dirty business and nobody likes jobs being cut from the bottom. At the moment, we know that the dividends are still intact. We're not expecting any of senior management to get cash bonuses this year, and there will be no pay rises for senior management until at least 2021.
Let's talk about the business of sports. Amanda Staveley, the high-profile businesswoman who has just brokered the potential takeover of Premier League football club Newcastle United, has accused Barclays of misleading her as she helped secure the billions of pounds that saved the bank during the 2008 financial crisis. And she's suing Barclays for up to £1.5 billion. What more can you tell us about this story, and what would this mean for Barclays Bank?
Well, it's a high-profile case, and Ms. Staveley is a high-profile businesswoman. What we do know is that the case has started by Weblink here in the High Court in London. And what she is basically claiming is that her firm, PCP Capital, have been moved out of £1.6 billion worth of profit or earnings. That came from a saving that the bank had in 2008 during the 2008 financial crisis. Barclays were looking for investment of up to £7.6 billion. And Staveley is claiming that her company managed to get Middle East investors to put in £3.6 billion into Barclays. And what she says is she wasn't paid any money for that, or she was cut out of £1.6 billion, which is why she is seeking these funds in court. Now, Barclays have obviously responded to the claim, and they say that it's misconceived, it's without merit, and they will be fighting this battle to the bitter end. But there's been lots of scenarios where Barclays have come out a little bit dirty during the 2008 financial crisis. Earlier in the year, two very senior bankers were accused of fraud and taking money from Qatari businessmen. But Ms. Staveley says that she's owed this money, and she's obviously taken it to court, and we'll see how that plays out in the coming days.
Yes, indeed, Juliana. Now, the UK and Japan are set to begin talks aimed at reaching agreement on a post-Brexit trade deal. Now, if they do reach a deal, what will this mean for the UK post-Brexit?
Well, this will be great for the UK. Of course, Japan is not the only trading partner Britain is seeking to renew its ties with, but it's certainly one of the biggest. Last year, I believe trade between the two countries was worth about £30 billion. Japan, of course, third largest economy in the world, and Britain's fourth largest trading partner. So securing a tariff-free trade deal with them is extremely important. At the moment, they do already have one, but they have one under their European Union membership, which will end properly at the end of this year. So they want to make sure they can secure that deal, as well as other deals. They're having conversations, of course, as we all know, with the United States of America, with New Zealand and with Australia, and they do want a similar deal at the moment. Liz Truss, who's working on this, she's the Trade Secretary. She said that she wants the deal between Japan to go much further than the one they already have with the EU. They really want to hone in on digital investment. So yes, that's taking place today. So Britain and Boris Johnson, the Prime Minister, will be really happy if they can secure that by summer.
I can imagine, Juliana. Thanks for the updates. We'll see you again later.
Thank you.
And Temple Shaju is coming right again to give us an opening call to the debt and currencies market. Over to you, Temple.
Thank you, BC. Well, yesterday, the last trading session, we got NASD OTC declining by 44 basis points. CSCS contributed more to the volume of transactions, and had some 6 deals of the 7 deals that we had here. But the Niger Delta Exploration Production Company was the only one that had 1 deal and contributed more in terms of value to the market. For the debt end of the markets, we got investors still looking at the longer end of the curve. Eventually, we know that yesterday there was a bit of stability in yields across the market. 4 basis points of yield was what we saw yesterday because, again, there's been so much of liquidity squeeze in the system, and that's not really helping investors, a lot of the dealers and the treasurers that you have in the market. If you recall, last week we saw a CRR debit by the central bank from the system, and that reduced the system liquidity very, very drastically. Look at the NCB ends of things, more of retail trading. The 13th of May 2021 paper continues to see a lot of bidding basically across board. And of course, for the OMO end of things, investors continue to give interest to the longer end of the curve, where you have January 2021 and May 2021. But we have joining us now via phone Ajibola Ero-Phillips, who's the FX head of FX trading at FBN Quest Merchant Bank. Thank you for joining us on the program, Ajibola. So, Ajibola, we know that yesterday, if you look at the I&E window, we saw a situation where the volume of transaction reduced to the lowest at about 2 months low now. We saw some $14.6 million exchange hands there. Is this some sort of concern to traders at the market?
That seems to be our new normal these days. Volumes in the I&E are the lowest end that we've seen since the introduction of the market. There's been some encouragement, though, because sometime last week, Friday, there was a bit of flows into the market. About 100 million was traded. But, the trend usually over the last time since all of the whole pandemic and all of the attendant issues, total trading volume for week has usually gained the 200 million. So, this is really our new normal right now. The volumes are really at their lowest since the introduction of the market.
And as you try to cope with that, Ajibola, I do hope that you will make good use of the 85 billion naira worth of liquidity level that you found yourself this morning in the system. Thank you very much, Ajibola Ero-Phillips, head FX trading with FBN Merchant Bank, for sharing your thoughts. You see, it's back to you.
And as we always say, we hope for a profitable trading day. Thanks, Temple. And that's where we end today's program. Thank you for watching. I am BC Adebayo.